Hello, everyone. Welcome back to Current Economy and Investment Insights. This information that we're going to share with you is as of August 31st, 2020. Paul, of course, is co-hosting with me from Ameriprise Financial, and Paul's going to give you a kind of a recap of what took place last week in the financial market.
Thanks, Ron. So today we're going to talk a little bit about inflation and question, is inflation truly a thing of the past? So let's begin. There are two main types of inflation: demand pull and supply push. Now, the OPEC oil embargo of the early 1970s is a well-known example of supply push. The U.S. was highly dependent on oil imports at the time, and OPEC decided to stop selling it to us, and the price jumped due to the scarcity. A lack of supply pushed up prices for gasoline, plastics, transportation, and lots of other stuff back in the 70s. Historically, demand pull has been a more common issue and the primary focus of monetary officials in their efforts to contain inflation. Lower interest rates or too much money in the system typically leads people to increase their consumption, thus pulling prices higher as people bid up prices for goods and services, and you know the story from there. But what happens when slower population growth and technological advancements enables supply more easily respond to demand fluctuations? Additionally, what happens when societies age and people simply spend less? Those days are what we may be in today, largely due to demographic trends in most major regions around the world. So over the next year or so, inflation measures are likely to see a lot of push-pull on their own. Supply disruptions in many manufacturing sectors, combined with relatively strong finances for many consumers, has led to product shortages, thus rising prices in several different product categories. Meanwhile, falling rental rates amid an outward migration from cities due to the work-from-home boom is likely to offer considerable downward pressure on inflation metrics for several quarters in our view. We do have charts that highlights the underlying trends in U.S. inflation when fluctuating food and energy costs and shelter costs are both removed. And as we can easily point out, the inflation beast has been weakening, but offers economic challenges on its own when that type of trend happens.
And as of this morning, Ameriprise had supplied us with the latest information that took place as of either after market on Friday and as of this morning. The S&P 500 index futures are pointing to a higher open, with the index on pace for its best August in over 30 years, Paul. Unbelievable.
It's been an amazing run for the stock market recently, especially since the March lows we created from the COVID drop. Who knows? I mean, that's how the futures are pointing. The market could open up down and we could have a down day. You never know. We've got to have one at some point. Today may be the day. Who knows?
Yep, I got you. Stocks in Europe are mostly higher as dovish U.S. monetary policy continues to provide a boost to global risk assets.
That's good, and we've said we're a global economy. Everything is interconnected. We trade, we buy and sell overseas. So to see their markets up, that's good.
And the U.S. Treasury yields are steady ahead of several speeches from FOMC voting members this week. Both Apple and Tesla are higher in the pre-market trading, with both firms' shares now trading on a split-adjusted basis. And after Friday's action, actually in the market, the Apple split 4 for 1 and Tesla split 5 for 1. Very interesting. And then the year-to-date, NASDAQ and S&P 500 is still strongly in the positive territory. That's really good news that we're hanging in there. And then, of course, the Dow's hovering at a break-even point year-to-date as it stands right now.
Those are the three main indices that a lot of investors look at, the Dow, NASDAQ, and the S&P. And like you said, it's been a wild year with the COVID sell-off early in the year, the rebound we're experiencing now. So the Dow investors are hovering, like you said, around break even, with NASDAQ and S&P investors well in the positive territory on the year.
Well, so far, everything is good, good, good.
So far, right? You and I both know how quickly things can change.
Yes. Within an hour, everything could change. But stay with us. We're going to be right back. We're going to be bringing you a little story on your money. And Paul usually has a good topic to pay attention to. Stay with us. We'll be right back. And we're back with your money. Thanks for staying with us. Paul has an interesting topic, tax loss harvesting. Paul, why don't you get into it and let's hear about it.
Thanks, Ron. Ron and I talked about in the first half of the show how the market has recovered, the S&P and the NASDAQ to positive territories year to date, but certain sectors are left behind, and investors in those sectors may still be showing negative investment returns year to date. And with that being said, we're going to talk about tax loss harvesting, what you might want to do with those negative investments at this point, and we'll kind of dive into it. So let's begin. One possible upside to this down market and these down sectors I mentioned comes from a long recognized strategy called tax loss harvesting. The concept took a back seat in the midst of an 11-year bull market, but it has jumped back into discussion now. Given the dramatic drop in investment markets earlier this year and the sectors that have not recovered, many investors may hold long positions in stocks that have lost ground. In the right circumstances, generating a tax loss by selling specific securities may be advantageous. So let's talk about it so you can know what you need to know about this. It is a potential tax saving strategy. So tax loss harvesting strategy applies specifically to investments held in taxable accounts. Since the current taxes applied to IRAs or work-based retirement plans, this strategy is not applicable in those IRA or 401k type accounts. The tax benefit of selling a security in a loss position is that those losses could potentially reduce your tax liability. So let's take an example. Suppose you invested $10,000 to buy 1,000 shares of stock, hovering at about $10 per share, maybe over a year ago. Today, let's say that stock value has dropped to $8 a share. So you lost $2 a share on your investment. And your investment is now totaled at $8,000 instead of the $10,000 you originally put in. The stock may recover and eventually appreciate in value. But if you sell it today, you could potentially claim a $2,000 long-term capital loss. The question is that the right choice for you? Let's look at the upside of tax loss selling. One deciding factor is whether you have investment gains that can be offset by the losses you incur from selling securities in a negative position. Long-term capital gains you claimed are taxed at rates of either 10, 15, or 20% based on your federal tax return. So if you had $3,000 in a long-term capital gain to claim on your 2020 tax return, that would come with a federal tax income bill of about $450 if you're taxed at the 15% rate. If you lock in a $3,000 capital loss, it will offset that gain and eliminate any tax liability with respect to the capital gains. So likewise, if you own mutual funds in a taxable account, they may pay out capital gains distributions on this year, even if they're not performing well at the present time. Those gains can also be offset by capital losses you claim. Note that you may not need or want to offset capital gains if your taxable income, including the gains, is $40,000 or less, for single tax filers or a married tax filer filing jointly, or $80,000 or less for a married couple filing a joint return. Taxpayers with income and taxpayers with income and gains below those income thresholds qualify for a 0% tax rate on long-term capital gains. Singles and married couples filing a joint return can use up to $3,000 of net capital losses to offset ordinary income, or $1,500 for a married filing separately tax filer. Beyond that, unseen losses can be forwarded to offset potential taxable gains in any future years. Finally, some cautions about tax loss selling. The downside to selling a position that has suffered a loss is that you can't purchase that specific security or one that is substantially identical 30 days before or after the sale of a loss. Choosing to sell also means you sacrifice the potential to benefit from a rebound in the price of the security. You want to be certain that you are comfortable not owning a specific security for a period of time that could be a candidate for tax loss harvesting. Most of all, any buy or sell decisions you make regarding your portfolio need to go beyond the tax consequences. You always want to talk to your financial advisor about how tax loss harvesting opportunities fit into your overall financial plan, and also be sure to consult with your specific tax advisor as well to understand how these rules I talked about take place. I'm not a tax advisor, I'm just speaking in generalities today to give you ideas with your portfolio. But Ron and I, we always stress that you need to talk with your tax advisor and your financial advisor before you take any action on your portfolio.
Paul, I have a question on this topic. Can you spread your loss over more than 1 year for tax purposes?
Great question for a tax advisor. Potentially you can spread that out in future years, carryover losses, potentially. But again, I'm not a tax advisor. You do want to confirm that with your own specific advisor.
And that's all the more reason you should be talking to someone that's a professional to give you that guidance.
Right. This stuff gets complicated, you know, and I spit out a lot of numbers on income and tax rates, and those are fluid too. Those things do change year by year. So again, for like the fourth time, we can't stress it enough. Anytime dealing with tax issues, you really need to consult with a tax advisor before you take any action.
It's a good recommendation. To be accurate and not have your tax return being objected by the IRS and then you have to redo it or whatever. It's not worth all that.
Exactly. So I'm not your person to help you with tax questions, but with financial questions that I can help you with. So if you don't have a financial advisor, or if you're looking to get a second opinion on the one you're working with, feel free to give me a call directly. I'm at 708-226-3412.
Thanks, Paul. That was a good topic. Very interesting. We're getting into the period of thinking about what we're doing for the balance of the year. So that's good advice.
Well, and it fits well because portfolios are unbalanced at this point, meaning there are certain sectors that are down on the year. Airline stocks, travel stocks, maybe some hotel stocks, oil-related stocks potentially could be down in your portfolio versus your growth-type, internet-type stocks, Zoom Media, Amazon.com, Apple, Tesla, things we mentioned. Those could be up for you on the year. And you might want to swap out taxes in that situation. So it's a timely topic and one that would fit a lot of portfolios right now.
Well, again, thank you, Paul, and for bringing Ameriprise information as well. For Paul Minical with Ameriprise Financial and myself, Ron Jankowski, with Channel 4 and Palos Heights, we wish you good investment day.